Good morning, Remax West agents. I hope you had another good weekend. Let's dive into the world of bonds. For all of you real estate professionals, there's something that could have a significant impact on your business as well as your clients, whether they're buying or selling in this current market. So, mortgage shoppers and those with upcoming renewals might be in for some good news next week or in the upcoming weeks with a drop in bond yields. Just this week, the 5-year Government of Canada bond yields fallen by over 30 basis points down to like 3.79. It's quite a drop, especially when you consider that it's down more than like 60 basis points from a recent high of 4.42 in early October. So, what does that mean for you? Well, for the rate watchers, this suggests that the bond yields could lead to some rate relief in the mortgage market by next week. However, having said that, don't expect interest rates to drop as quickly as the yields have. Like they say, rates take the elevator on the way up and then they take the stairs on the way down. So fixed mortgage rates are expected to start falling, but probably by only 20 to 40 basis points over the next couple of weeks, depending on the term. So it's good news for your clients who are looking for mortgages or they're planning to renew in the next little bit. So, but it's important to note that while rates come down for mortgages, they might not drop as much as we had hoped. So lenders and mortgage providers are probably banking and keeping a little bit more for risk, given what they consider for the economy as far as a downturn. And I think that they're just going to keep those spreads as some cushions over the next little bit. So the driving force behind the bond yields, just so you know, is that it's all based on the economic data that's been coming out. And the Bank of Canada doesn't see, or the Federal Reserve for that fact, raising rates for the next little bit. So they're taking what I like to call a hawkish pause. And there's a slowdown in consumer spending, credit growth, housing, obviously we see that, and now unemployment seems to be on the rise. So while most of the big banks' forecasts don't expect the Bank of Canada to begin to be cutting rates until the middle of, 2024, markets are betting that a weak economy might force the central banks a little bit sooner. So bonds are pricing in about 83% probability of a quarter point rate cut by March of 2024. And then, there's another probability of maybe 50 basis points after that. So, they could start cutting interest rates before inflation reaches their target rate of 2%. But that's probably not going to happen till, I think the deputy minister said until like 2025 or something. So that's really interesting that we're probably not going to wait for rates or inflation to get down to 2% before we see rates drop. So that's an interesting development. We're going to have to keep an eye on this sort of thing, and it will have an impact on your clients' purchasing power and the overall market, of course. And as mortgage rates adjust, it might influence the decisions that your buyers and your sellers are going to be making over the next little bit. So we're going to have to stay informed and just continue to pay attention to what's happening. Stay in touch with your clients. I'm still always happy to help and support. And let's see what we can do.